Good morning, everyone. I'm just following the starter's instructions. On behalf of National Australia Bank, we're super pleased to be working with Alta Domus this morning, hosting today's webinar. My name is John McCluskey. I head up NAB's European business. I'm usually based in London. I'm currently coming to you from Melbourne, which is also in lockdown. With a handful of cases, you'd believe if you've been watching the Australian Open and the tennis, but probably less than, I think, 10 or 13 today. But nonetheless, we're still in lockdown. I'm sort of waiting to make my way back to the UK. But such are the marvels of Zoom and webinars spanning regions and time zones that we can all carry on. Again, our thanks to Fred and the team from Alta Domus for their cooperation in joining to host today's event. I'm going to hand to Fred shortly. How this came about was one of my colleagues who has a long relationship with Fred. We began talking a few months ago and observed that our client bases look very similar, but we have very little overlap in the products and the services we offer, hence giving us an opportunity to work together on events like today to explore how we all think about adding value to our customers. But before I hand over to Fred, some people on this call who I don't think really know NAB and what we do terribly well. We're one of the few AA rated banks, and we've been operating and servicing our UK and European clients out of London for well over 150 years. We're about to strengthen that footprint and also establishing a European subsidiary in Paris to better service clients based on the continent. We're hoping to have that operational by the end of this calendar year. In our London office, we have a very sizable markets business dealing with institutional investors, corporate treasuries, across the UK and Europe, covering rates, FX, derivatives, debt securities, commodities, and various hedging. But we've also got various debt arranging and origination teams, also focused on our specialist capabilities and strength. Debt capital markets origination, Australia, New Zealand, UK and European issuers. More recently, we've established a very strong presence and growing credentials in UK securitisation, and in particular in RMBS. We're lending to UK social housing. We've got specialisation in fund financing and insurance sector. And we've got a very, very dedicated focus on infrastructure and renewable financing. In fact, NAB is rated #1 as of the Aussie banks of lead financing to infrastructure and renewables. And you'd be surprised, many surprised, that we rank in the top 10 globally. At NAB, we're also very well rated for our Australian and global institutional investors for our leading economics research and forecasting team. And that's what we're here for today. So we're starting this morning with Gavin Friend, who heads up the research team based in London. We've started with the small topic, the economic and investment outlook for 2021, dealing with the uncertainty of Brexit, a Biden administration, and dealing through COVID. We've also delivered Gavin a very small challenge today of getting us through that in about 30 minutes. And then we're going to have 15 to 20 minutes for some Q&A that will be facilitated by two of my London colleagues, David Holloway and Katie Renouf. You'll see there's a Q&A tab at the bottom of your screen. Please feel free to post questions as Gavin's taking us through his presentation, and we'll address those at the end. And we're also going to be forwarding a link of the presentation of today's event, so you can refer to it later or use it with some of your colleagues. It's certainly going to be quite a year for markets and investors. Central banks aren't withholding or withdrawing support. Investors are getting more nervous around massive deficits and ultra easy monetary policy, potentially driving inflation pressures. But is that fear well placed or just an opportunity? And we're going to hear from Gavin, given the massive slowdown in activity, damage to individuals and businesses through COVID and through the shutdowns that keep continuing. So with that, I'm just going to hand over to Fred to say a few words as welcome, and then he's going to pass on to Gavin. But on behalf of the team at NAB, very many thanks for joining us, and I hope you enjoy the next hour.
Good morning, everyone, and thank you, John, for that introduction. I suppose most of you will know us, Alta Domus, but for those who don't, I'll just do a brief intro. We are a fund administrator, and we're specialized in real assets. So that is private equity, real estate, credit, and debt and capital markets. We have now over $1 trillion assets under administration, and we are present in 36 jurisdictions across the continent in all the places that matter for financial services. So that's Europe, obviously, the US, Asia, including Australia. So that's where this partnership with National Australia Bank is also meaningful to us. And we offer administration solutions to fund managers across the entire value chain. So that is administration, accounting, and reporting, obviously, depository, AFM in Europe, loan servicing, loan agency, and in other words, the whole suite of vertically integrated services, as we like to call them. I am myself the country executive for France, where our clients are investing in private equity and real estate. And fundamentally, we are fund administrators and we are producing accounting and reportings, but we like to understand what our clients do, and they're affected by the economic environment and what the perspective look like. So over the last few months, we have been very intrigued to watch how our clients were responding to those changes in the macroeconomic environment. And interestingly, we've seen a very sustained level of activity on all fronts. Certainly on our side, we've been extremely busy, but we've seen our clients being very active on fundraising and new funds launch, investment, divestment. So certainly not life as usual, but not necessarily what one might have expected back in March 2020, almost a year ago. And overall, we've seen an industry that's resisted pretty well to all shocks. So as we were discussing with John, Katie, our friends at National Australia Bank, and we're talking about the global environment and perspectives and where we could join forces and look at perspectives together, we thought it would definitely be interesting to organize this webcast today to get the expert views. So Gavin Friend, who is the senior market strategist with the economics research team for NAB in the UK, has very kindly accepted to share his views on what we can expect from a macroeconomic perspective and give you an opportunity to express your own view or ask questions on what we're doing at the end. We've had a number of conversations. I think Gavin initially came up with something like 95 slides or a lot more, and that we had to trim down to those 30 minutes we have ahead of us. So I'll make it short now and leave him more time to tell us what his views are.
I'm going to. Did anybody hear that? I'm going to start with a few words. Good morning, ladies and gentlemen. With a few words on the infections, injections race, and then we're going to move through to the impact on the global economy, and particularly the US, Europe, and UK. And then we'll have a look at some of the asset classes, FX, and yield universes. Okay, so Kelly, if I could have the first slide on the infections versus injections, please. Ladies and gentlemen, as we approach the 1-year anniversary of COVID-19, at least in terms of how it engulfed the global economy, it's easy to forget that after the initial shock and the huge hit to GDP that we saw in Q2 last year, the received wisdom was that things would then gradually improve from that point on. Instead, economies around the world turned down again in Q4 amid sort of stop-go, more protracted restrictions and lockdowns. And Q1 this year is turning out to be a bit of a train wreck for some economies, particularly in Europe and the UK. For those of us who are not epidemiologists or virologists, we have learned that viruses mutate. We've also learned that in the Northern Hemisphere, we were much less protected or prepared than Asia, which had the experience of SARS, of course, and the effective track and trace systems and quarantines and lockdowns, such as those that have been operating for some time in Australia and New Zealand, are very effective. And we're just coming into that now in the UK. It's also unfortunate that in the Western sort of Northern Hemisphere, the winters are longer, they're colder, and we've, partly because of that, we've unnecessarily pushed our hospitals and health systems, to breaking point. So the learning curve has been steep. And, while there's, I suspect there'll be more mistakes, more lessons learned, the vaccine rollouts finally are moving at pace. Just a few weeks ago, investors were worrying really about the gap between, vaccinations and, more aggressive waves or strains of the virus. Europe's unfortunate bureaucratic vaccine procurement process and issues at some of the virus manufacturers haven't cloaked the EU Commission, in glory. But despite the recriminations, even in Europe, the pace of vaccine rollout is due to really ramp up. So we know that the UK, with much fanfare, has hit 15 million of the most vulnerable people, around almost 20% of the population have been vaccinated. And that run rate now is sort of 450,000 to 500,000 a day. So, you push that out, you're talking about 20% of the population per month. The US is vaccinating about 1.5 million citizens a day, which would see 25% of the US population vaccinated in 2 months. Germany, like many countries in Europe, the run rate is much slower. It has been. They've been vaccinating about 100,000 a day, so 2.8 million a month. That's roughly what the UK does in a week. But reportedly, is ready to have its most vulnerable groups, nearly 30 million people, vaccinated at least once by Easter. So that means over the next 6 to 7 weeks, vaccinations in Germany will grow tenfold. The EU and the US have their most, or aim to have their most vulnerable citizens vaccinated by the summer, with full vaccinations by the end of 2021. And we can see that in the chart there on the, say, the BBC chart. Next slide, please, Kelly. There are big questions, I think, still about the developing world and whether this rollout could be done sort of more equally, more equitably. But the scientific concern, of course, is mutations and whether vaccines can be adapted quickly enough to, in this race of infections versus injections. It used to take 10 years plus to develop, a vaccine. The brilliant scientists around the world have come together, a number of trials and bits and pieces, and they've cut back to 1 year, as we know. Now, as the threat of mutations takes hold, drug companies are becoming more confident that with the assistance of the various regulators and medical bodies around the world, where they can avoid full 3-phase trials, this can be cut to just 3 months. So tweaking these things in 3 months, which is obviously fantastic news. The risk, I think, is that rather than a crisis, with a beginning and an end, this looks like it could be sort of a reoccurring challenge with new variants, new mutations, threatening and requiring vaccines and vaccine tweaks, and that this becomes the new normal for a sustained period of time. It's also possible that citizens will require perhaps a third booster rather than the 2 as these mutations continue and the vaccines become less effective. The chart on the left of these 2 on this slide really is just a graphic illustration of who's buying the most vaccines. Canada is, secured 9.6 vaccines per head, the UK second at 5.5. Both of these countries suitably above, their peer group. Next slide, please, Kelly. And so the discussion now is the markets really is inevitably going to shift to this reopening phase. It already is. We've got Prime Minister Johnson set to lay out the schedule, the strategy next week. And the idea is that the economy will be, reopening at some point in March. That seems to be the message from Europe as well. Even Merkel, who's been very, very, cautious about this, is talking about moving in early March. The two charts that you see here, the chart on the left, I should say, is really just showing us that we've had this, big drop off in activity, a nice recovery, and then we've rolled over a little bit, as we go Q4 and Q1. The two charts, center and right, are just showing us. So the middle chart is Google GPS data that shows you mobility. And I think what's interesting about this is even though we've had mobility, crimped by these sort of lockdowns and the restrictions, you can see that, in the last few months, you're not seeing an equivalent drop off in activity. And that's the third chart, the left-hand side of that, which is manufacturing, PMIs across a number of countries, and then the service sector. And you can see the manufacturing really, stepping up a gear. We know that manufacturing is not really in the front line. It's the service sector that takes a hit. But even there, the US is doing very well. UK and Europe not so well, but we're not seeing the kind of falls off in activity levels that we did in the first lockdown. And that's, I think, because, businesses transit, they learn, they adapt. And I think probably some people don't perhaps take all of the lockdowns, as seriously as perhaps they are asked to do. Next slide, please. So we'll just have a quick look at the US economy. Activity, as we can see in the top two charts, in manufacturing and the service sector, has actually rebounded really well. I think these charts are a little bit, should we say, mischievous. Some of the things that have been pushing up activity here have been things like prices paid or supply deliveries. And they're not good. They're not good developments. They're things which are going to push up the index, but that actually doesn't mean that the economies are expanding well. So they're not quite as really as positive as they seem. But still, things have picked up very nicely. We know that in small business, across the NFIB small business survey, optimism has fallen. That's the chart left bottom, has fallen off quite sharply. Hiring investment plans are down, no surprise. Consumer confidence, top right, that's the conference board. Again, no surprise with these repeated restrictions and lockdowns that confidence has ebbed a bit, and confidence looking forward as well. We know that 10 million Americans are still without jobs. The December payroll numbers we saw were negative. The rebound in January has been welcome, but it's not really been, it's not a strong rebound. It's not as strong as markets were looking for. Yes, the unemployment rate has rolled over down to 6.3%, but it's still a long way from what the Fed will call full employment. The equity market rebound and higher house prices have helped, household balance sheets. If we flick to the next chart, please, Kelly. And we can see, net worth has pushed up, not for everybody, of course, but for those, the rebound in equity markets, house prices have gone up, household savings, because this is an enforced lockdown, household savings have gone up, disposable income's gone up. And we know Donald Trump enacted a $900 billion stimulus plan at the end of last year. We know that Joe Biden, with his pandemic relief plan package, is looking to, push in another, what he wants, 1.9 trillion. We think more likely he'll get somewhere between 1 and 1.5. Trump's impeachment process now over means that Congress can really focus on this and get this investment plan working. Biden wants, as you know, to take a sort of a bipartisan approach. He wants, that's his idea, to try and heal the divide in America. But at the same time, he's also got a very small majority, and in the Senate, also in the House, and he's already tapped the budget reconciliation process because he doesn't think he's going to get this through fully in a bipartisan way. This has led to some bad blood, of course, in Republicans. They say that the debate, the argument is not genuine. You know, the battle in the Senate is obviously just by one vote with Kamala Harris, the VP. In the House, Republicans have got 222 seats. They need 218 for a majority. So they've only got 4 space. We've got a couple of Democratic senators from Virginia and Arizona who already are pushing back against Biden's plans for the $15 minimum wage. And he can't really, afford to lose that. So that's why we think, the bottom right chart there, he's proposing 1.9 trillion. He'll probably end up with something about could be as high as $1.5 trillion, as some of these areas are pared back just to get it through. The minimum wage apparently will kill something like at least 1.3 million jobs. So it's a controversial issue. And we know that the 1,000 checks that are going to go out, some of that, some households don't need that money. It's going to be a real boom to the economy. So you've got, 1 to 1.5 trillion. You've got the savings hoard, vaccine-led reopening, and all of this is going to release, a fair degree of sort of pent-up demand. More of that in a moment. Just looking at the European economy. So it does look like we're heading for a double dip in Europe. Q4 growth was down 0.7%. That belies a very mixed, outlook really across the economies. Germany was up, just scraped recession, growing by 0.1 percentage point. Italy was down by 2%. France was down by 1.3%. Spain did better, growing by 0.4%. So for the whole of 2020, Europe was down by 7.2%. The extended lockdowns, the slow vaccine, all of this means that Q1, there's no way that Europe can avoid a negative print in Q1, and so therefore we'll get that double dip. German manufacturing is the strong point. Chart there, top left, you can see, it really is robust, partly because they've managed to sell to the rest of Europe. They've managed to sell manufacturing kit to Asia, particularly China. Those exports have held up well. The trade balance, surplus is lower, but it continues to be strong. Services, not so good. Chart second on the left at the bottom. Again, that's what you expect, but things should pick up. We'll get this nice rebound in Q2. Really, markets are kind of forgetting what's going on in Q1, really looking towards Q2. That vaccine procurement that I talked about, really will help the European economy when it gets into the second quarter. Just thinking about, thank you, Kelly. Just thinking about the unfortunate issue that Europe had with the vaccine procurement, which kind of dented some of the positive sentiment that was there hanging over Europe from this next slide, which talks about the Next Generation Recovery Fund that Europe is, pushing onwards. It's had a couple of false starts. We had that issue with Poland and Hungary last year. Markets have moved past that now. That's going. The recovery fund is set to go. The first disbursements will be paid out sometime May, June. It does need governments across the European Union to really get their act together and start talking about how they're going to spend the money, putting their budgets, their plans together for this to be realised. We know that there's a huge amount of money coming in, sort of $2.36 trillion over the years 2021 to 2027. We know that there's 750 billion of grants and loans About 40% of that is going to go to Italy and Spain, and half of that will be grants, so they won't be paying that back. All of this is good. You know, there's the potential game-changing, here of aspect of Europe actually moving to debt mutualization. You've got very skeptical countries in Northern Europe that really don't want to do this. They've agreed to this because they think it's going to be a one-off through the COVID. A lot of this really depends on Italy, and it's very good that we've got former ECB President Mario Draghi in the hot seat. He's got a really big job, in trying to end the bureaucracy, cut the red tape, sort of enact competition and judicial reforms. There's a big 30% youth jobless rate in Italy. He's got to tackle that, and he's got to show the rest of his European partners that he can reform, and that actually Italy can spend its money wisely. If he can do this, it's no mean feat. But if he can do this, and he's obviously got a lot of support and a lot of goodwill at this point, then that will go a long way to convincing countries like the Netherlands and Denmark and others, Scandinavia, that fiscal unity could be real, could be more sustainable. It could be, a game-changing, longer-term thing, which would really buttress the existing monetary union. All of this is, dangling. It's Europe's to go for. What we particularly like about the recovery fund is about a third of it, Europe wants to push forward to renewables, to climate change. There's a digitization of the European economy. There's a good chance here then that, if Europe does this properly, it'll take a bit of time, but it actually can raise its long run growth potential. And, I think it's that kind of thing that when you looked at the US economy, when this came out last year with Donald Trump in charge, yes, we had the fiscal, the 1 trillion fiscal sugar rush, but it was just a sugar rush. We didn't really raise the long run growth potential of the US. And that's the big question for Joe Biden. He also has a very aggressive infrastructure plan, around $2 trillion. He wants to get that going later this year, if he can. There's a big digital component to that as well. But we're not sure whether he's going to get it through. The numbers, the arithmetic in Congress are so close. It's touch and go whether he can do this. So I think, this European Recovery Fund is a real thing. It will be going live, in a couple of months' time. It will be a big boon to the economy. And I think their markets will slowly sort of fade their memories of what happened in the last 2 or 3 weeks with the vaccine rollout. That'll fade into the rearview mirror, and people can focus on this kind of thing. And I think this is one of the game-changing things. It's one of the reasons why we have a positive view on the euro. Notwithstanding, it is quite difficult, clearly, to get 27 countries, in the same room to do the same thing. Okay, next slide, please. So the UK economy, it's not had, fair to say, it's not had, the best of times. Late into lockdown, lots of stop-go policies. We're only now introducing this. We didn't get track and trace working properly. We're now only, getting to grips with quarantine measures and those kinds of things. It's all very welcome, but rather late. And as a result of that, the UK has been the weakest of its peer group. Growth last year falling almost 10% over the year. You compare that with the US at 3.5%, Eurozone at 7.2%, Japan at 4.8%. And we know because of the protracted lockdown that things are going to get worse before they get better. Q1 is going to be very, very very disrupted, and we're not going to get to the growth stages until the second quarter. Excuse me. But there's that chart again on the bottom left. Vaccinations. The UK truly does have a world-beating vaccination policy. It was a really good write-up for anybody that wants to do more about this in the FT at the weekend, about how this was all planned summer last year. and the huge logistics operation that went into it with the army and what have you. And touch wood, it is working really well so far. We know that, like a lot of these major economies, because this is an enforced lockdown, it means that savings rates have gone up. The Bank of England has calculated that something like 125 billion has been stashed away, and that this could rise to something like 250 billion by the middle of this year. Andy Haldane, chief economist of the Bank of England, a bit of a renegade, but he likes to go off piece a little bit. But he thinks that economists are being far too gloomy on the UK. We know we've got a trade deal. The trade deal was very welcome, a free trade deal. I'd like to call it Canada Plus because, it does all of goods. It does food and agriculture in a way that the Canada deal didn't. It will do some services. Clearly, Europe is in no hurry to get equivalents on financial services for their own reasons. That will be coming over time. We can say that we know that the deal we've got isn't as good as the deal that we left with, at least in terms of the sort of short to medium term, because it's going to take a while for the UK to rebalance its trade, and that's just going to take a period of time. It's also going to take a period of time to get technology to help the UK so that it can start to ease off some of these sort of restrictions and things that we're finding at the borders at the moment. But all that said, UK now with this vaccine rollout has got a chance to, really push up. Andy Haldane's looking for 5% growth this year, 7% next year, which really would be quite a boon. Next slide, please. So as we look at the global economy, this is NAB's forecast for the last few years, and then obviously this year and next year. And we can see, above trend growth for the global economy, 5.8%, led by the advanced economies. All the major economies growing, apart from Japan, with the four handle. China obviously growing at 9% plus, India 10%, all very, very welcome. And this, along with some of the other issues that we're seeing, the huge amount of fiscal spending, the pent-up demand is likely to really push people into this reflation trade. Next slide, please, Kelly. So, you're reading a lot about the reflation trade. If you're watching Bloomberg, it's front and center all the time. The drivers of the reflation trade I've set out here. We've got major economies coming to the end of this extended lockdown. We've got, this was a recession not because of involuntary savings, but precautionary savings, but involuntary savings, and so that's going to come out. Net wealth, as I already talked about, savings have moved up. Fiscal policy, is continuing to do the heavy lifting for most of these advanced economies. We had the Trump stimulus of 900 billion, sort of about 4% of GDP. We know that the second stimulus from Joe Biden is going to be worth, depending on where it lands, whether it's trillion and a half, or more than that, between 4.5% and 8% of GDP. I've said before that some of these households don't need some of this money, and it's just going to, go out there and be spent. The Next Generation Fund in Europe, I think, will be another prop. We know former Fed governor, now Fed chair, now US Treasury Secretary Janet Yellen, she has been urging Congress to go big. She's talking about historically low interest rates. There doesn't seem to be at this stage within the Democratic Party what people feared with the blue wave, which was that they would be looking to put in some tougher regulations and tax hikes, those kinds of things, which would spoil the party. All of that seems to be a story for tomorrow. It'll come, but it's further down the road. And if it does come, because the arithmetic is so tight, again, we don't know. It's not a given. So the Fed, led by Jay Powell, increasingly, joining Janet Yellen on that stage, talking about how we need to help people who have not benefited from what's been going on. They haven't had they don't own stock, they don't own a home, they've lost their jobs perhaps, they have a small amount of savings, and they haven't, been helped out at all. And, Jay Powell is trying to, because he knows that prior to the downturn, the US saw 3.5% unemployment rate, and still couldn't get inflation. Now he's saying, look, after the extent of this pandemic, surely, we can have another crack at really trying to push down, squeeze out that spare capacity that we're seeing in the labour market. And we can worry about inflation a little bit down the road. At the moment, so the Fed's adopted this new average inflation target, which will allow them to look through inflation in the short term. They're telling us they're not going to do anything until and if they see full employment, whatever that is, and we don't know. Inflation targeting central banks around the world have tried. They thought they knew where Nauru was. All of them have missed it. Nauru is lower than where they originally thought it was. That's the task. Is it 3.5%? Is it lower? Technology change, AI, all of these things will feed into this. But they also want to see at the same time inflation above 2%, and for it to stay there for a sustained period before they're going to change anything. So all of these things are coming together, and driving the reflation trade. Next slide, please, Kelly. So we're seeing this, it's been manifested in things like inflation breakouts, break-evens. So, the 10 years, the top chart on the left, it's been led by the US. Break-even inflation rates are up to 2.25, 2.3 now, from what the low was just below 0.6, 60 basis points. You're seeing moves in Germany, in Europe, in Australia, in the UK, not to quite the same extent, although Australia's having a good go. It is the US that's obviously driving this. Curves are steepening. So 2s, 3s, 5s out to 30 years, curves are steepening. That's going to continue. We're seeing, because, excuse me, because this is, it's seen to be a good, markets are embracing, if you like, the Fed policy. They see the Fed policy as credible, and because it's built on, solid growth foundations, we're seeing stocks moving up. It's lighting a fire under commodity prices. Oil prices are also going up. Various other asset classes. You're already seeing some switch and some rotation geographically. EM stocks, for instance, the MSCI EM index is outperforming the S&P over the last few weeks. You're seeing rotation within sectors as well. Some of the beaten up stocks, things like banks and staples, are doing well. Banks, because of the steeper yield curve, you're seeing their stocks moving up. All of these are going to continue over the next few weeks and months. Next slide, please. And I think, really it is the markets, the behavior of markets. We can say, yes, we're pushing yields up. Nominal yields are moving up reasonably slowly. Break-evens are going up quite sharply. It's that real yield. Chart on the bottom left, 10-year real yields. It's the same in Germany. They're absolutely flat. They're not going anywhere at all. And that's telling you that markets have faith in the Fed's new policy and average inflation targeted. If they didn't have faith, real yields would be spiking as well. There'd be a sell-off in the bond market in the real space as well. And so, this is going to continue. We have a debate going on through markets at the moment as to whether, inflation is going to spike and go horribly wrong. The chart on the right shows you that break-evens at the 5 and 10 year, we're still, despite the rapid run up, we're still really not going to where ranges that we used to trade. Back in the 90s and the noughties, there were prolonged periods of time, years, where US 10-year inflation expectations would trade between 2.25 and 2.75. So I think that's probably where this is going. So that suggests that nominal yields can move up a bit further. At NAB, my colleagues in the rate strategy department are looking for a gradual move up, 1.25 end of Q1, moving up through 1.5 to 1.75 perhaps by the end of the year at a stretch. And then that might mean that the TIPS yields start to rise a little bit, but they'll lag behind, or they'll stay roughly where they are, and then you'll get that push up in break evens. Next slide, please. And so, this is why is the Fed confident? You listen to Jay Powell. He doesn't want to talk about tapering. Markets, some investors in markets saying you're just going to inflation is going to get rip roaring higher, and you're not going to be able to stop it. And his view is we're not even going there. We're not even talking about that. We're certainly not talking about tapering. We don't need to. Again, it comes back to that top chart on the left, unemployment in the US, and the U6 measure, which is the underemployment, the long-term unemployed, both fell to all-time lows just prior to the pandemic, 3.5% in the case of the unemployment rate. A big spike up is coming back down now to 6.3. If you look at the Fed's central tendency forecasts, that's the red circled areas in the middle. The Fed doesn't see, the FOMC, the board itself doesn't see a return to 3.5%, not until 2023, and it's the bottom end of a range, 3.5 to 4.4. Janet Yellen last week talked about, if we get this fiscal package, if we go big, we can get to full employment next year. That's her view. It's not the view of the FOMC. And I think Jay Powell is saying, look, if we had 3.5% unemployment in early 2020, and we couldn't get inflation sustainably above 2%, there's your chart of inflation, top right. I've got core CPI and core PCE. PCE is obviously the one that the Fed focuses most on, and sees the black line. You can see even in that period after Donald Trump enacted the $1 trillion fiscal sugar rush, the tax cut, and we had bond yields going up above 3%. The Fed was hiking, commodity prices were screaming, inflation, it just looked at 2% and then came back down again. So the Fed wants to see that up there, 2%, and sustainably so. And it thinks it's got, time on its side because of all of the churn that's going on. We're not going to see, the Fed thinks, a turn. There's an argument, a debate to play out about, where is inflation sticky? Where's it going to come back from? Are we going to see wages start to push up as we see that pool of available workers start to shrink? Are we going to start seeing inflation up? The Fed thinks not. Next chart, please, Kenny. And so the Fed, the ECB, the Bank of England, they're all looking at various measures of financial conditions to try and make sure that things are easy, credit spreads, sovereign spreads, those kinds of things, and they're there's the idea of a taper tantrum is being pushed aside. Why, with the amount of issuance that's going on, would the Fed, if we did see a spike and a more unruly spike in nominal yields, our argument would be that the Fed would come in and perhaps increase its 120 billion per month asset purchases rather than do anything else, and try and just keep that down. So anchoring the short end of the curve at the moment, the 2s, 3s, 5s, means that there's less chance, we think, of a taper tantrum. Conscious of time, so I'm going to actually just speed through to FX, just because I think we're going to be running out of time. So I should go back one slide there, Kelly, just as a reminder. It is true that we're seeing some issues on inflation at the moment. Most of them are temporary. They are driven by higher oil prices, the base effect there. We've got supply bottlenecks going on around the world. You look at that price, the chart bottom left there, which is prices paid by US manufacturers. That's real. And this is the sort of COVID world that we're living in. It isn't going to be long lasting, we don't think. There are reasons for them. We've also got some technical factors coming through, like the reversal of the German VAT cut. We had a shift in the timing of the French winter clothing sales. Those kinds of things have really pushed up European inflation, which is the top chart there. Again, they're going to be temporary, we think, not part of the broader, and the central banks will look through this. Just flicking through to the dollar. So we use the dollar smile framework, which basically says at the bottom of the dollar smile, if you've got strong global growth, synchronized growth, the dollar falls, the dollar rises at either side of the smile, either in an environment of big risk aversion. We'll get bouts of that, and the dollar, you see, will come back, but we don't think it's it's sustainable. And the other sort of more questionable is if the US is leading global growth or leading its peer group. We've seen a little bit of that in the last few weeks, and that was really as much about Biden getting the blue wave, but at the same time, Europe doing a few missteps on the vaccine and just not really getting on its mojo. So it's that relative game. That game, I think, is still playing out. And our view is that we think the dollar over the next year and a half will continue to gradually decline based on stronger global growth, based on the real yield argument. Next slide, please, Kelly. And we don't, again, to go back to what I said earlier on, we're just not convinced that the US, despite the ability for Biden to spend, that he will get this through. We know that at some point he may want to do tax rises, which will be a bit of a dampener. That could boost the dollar. But we just think the optics look better for Europe to try and get this strong productivity growth going. The real yield argument is the one that has been driving the dollar. The chart on the right there is your 10-year real yield gap. We have a sort of a year to 16-month lead on FX. So in other words, that's saying that the dollar still has some room to fall before as that gap is closed up. And there you can see on the left, the nominal yields shadowing the push up in break evens, and yet the 10-year yield absolutely fat. And all the while that remains relative to what's going on to other real yields around the world, we think that that's an argument that's going to keep the dollar on the back foot. Next chart, please. Last year, or through the pandemic, it may surprise you to know that tick data out of the US showed that foreign holders of US treasuries sold almost $500 billion worth of US debt. That's the black line in the chart there. That's just telling you this is how the real yield argument plays out for holders of US debt. Next chart, please. One of the other big factors, perennial, is the current account deficit. Good relationship, inverse relationship with the dollar. This is the CBO estimates in the dotted line. They do not include at this point the Biden 1.9 trillion COVID relief bill. And so, arguably that deficit is going to get even bigger. And you could get to the situation where foreigners are saying, well, I either need more compensation in terms of yield to buy this, or I need a lower dollar. Next chart, please. The final piece of the jigsaw really is that the dollar has been extremely rich. Yes, it's come down in the last few months. We still think it's overvalued on a PPP basis or fair value basis, and therefore, it plays to our story of further weakness. Just finishing up, I think I'm going to speed through to the euro and sterling just very quickly. Euro dollar, we have a forecast of 126, 125, 126 middle of the year. We think it's not going to be a rush up to that level, but we can sit around between sort of 120, 119 and 126 first half of the year. And then we'll extend up and we'll end the year nearer to 130. The chart on the left shows you that, there is, in normal times in FX, you would say that as the central bank expands its balance sheet, what would happen is that that would be a currency negative. In this crisis, actually, it's turning out to be the opposite. It won't always be the case, but it just goes to underpin the idea that, it's a sign of economic, of the central bank or the the authorities doing something to help the economy. We've got, what's going on in Italy is helping the Italian yields come down and closing in that spread between bunds and BTPs. There's a nice inverse correlation between that and euro dollar as well, top left. Next slide, please, Kelly. Just finishing on sterling. So your trade weighted index, that's your top left chart there. You can see the referendum, the big plunge in sterling. The trade weighted index is tantalizingly looking like it wants to break up into new ground and close some of that gap from the referendum. That feels about right. Yes, the UK is lagging, but now it's pushing, it's got a chance to push forward on the vaccine. Sterling was incredibly cheap. It seems right now with the UK leading here on the vaccines that sterling can just have a look at those kinds of areas. Cable, we've got a 142 forecast for March. I think actually that makes us the most aggressive, even though it's not that far away. We are the most aggressive on the Bloomberg forecasters for that in March, and then we move it up to 145. That big area you saw, 27, 2018, 142 is going to be a challenge to get through. It's not going to rush up through the old pre-EU referendum highs. Euro sterling, we weren't a fan of this coming down. Obviously, in the last few weeks, Europe's own misgivings on the vaccine have played to sterling strengths there, but we think it's going to stay broadly in that range that we've outlined on the chart there. Right, I'm going to end there because I'm running into Q&A time. Thank you very much.
Thanks, Gavin. What is that? David joined as well. You're on mute.
12 months of using Zoom, I'm still struggling. Dave Holloway here. I head up the Insto Sales team. Katie and I are going to help run through a little Q&A session for you today. So please feel free to add questions into the chat. There's a couple come through already, which we'll get to, and we'll try and keep Gav busy. We should be finished by about 5 past the hour. So for those who have to leave, by all means, but hopefully we can wrap this up reasonably quickly. Maybe Katie, do you want to start us off with one from your side?
Yeah, that's fine. And yeah, please do add any more questions that you have. So a question coming from Mattia at HD Consulting. How do you explain the resilience of the real estate market across all countries?
Well, that's a good question. Yeah, I mean, I think obviously the churn that's happened with the crisis, people are looking at where they're living and whether going forward, the working from home thing is going to be something that's going to be sustainable. And I think, we're seeing it in the UK, we're seeing in other areas around the world where people, there's a lot of churn, people moving out of the cities. It's obviously, the whole issue of investing in property is quite mixed, isn't it? It's quite sclerotic because, if you can find somewhere that's 2 hours out of the city, that's fine. You might want to invest in that. Cities, and office space, commercial real estate is much more difficult because we just don't know what the model of the future is there. And I think citizens are just voting with their feet to this new idea, because they've been given the opportunity in many, many businesses to actually work from home, an opportunity that without this pandemic probably wouldn't have happened because businesses would have said, well, it's not really possible. We've proved that it is possible, and it's opened up a lot of opportunities for people to kind of change their lifestyle. And I think it's no more complicated than that.
Yeah, Gav, I might just add to that too. Like just having been in Australia for a month or so now, it has been amazing. Like this time last year, how the marketplace was all talking about as COVID came, that prices would fall 10, 12, 13%. In fact, it's now turning the other way. I think, you're hearing a lot here about how, buying and, banks are offering 4-year fixed mortgages, which by world standards, not that low, but by Australian standards at 1 3/4%. And there's just been no supply. So, it's just been amazing, the turnaround here. And competition is very fierce.
Sorry. If I may add to that, I think real estate is an asset class we are very close to. It's actually a pretty mixed bag. So I wouldn't say that the market's been completely resilient. I mean, it's a lot of different stories if you're looking at residential, as you just mentioned. But if you're looking at commercial office, I think, Gavin, you said that it's probably too early to say, but residential hotels, they've taken a hit. And we've seen a rush towards logistics, commercial, last mile logistics. There's been this rush towards certain asset classes within the real estate. And I think, I mean, listening to you, Gavin, there was something that came to mind, and maybe a topic for next one, impact of, well, the influence of real yields on real estate and what that means for the market going forward. Because, you know, this is very strongly correlated, and how do real estate investors react to evolution in real yields? Going to be very interesting to look at in the next months, I think.
Yeah, great.
Thank you, Fred and John. It's really interesting. The next question came through, Gavin, and it goes to your comments about arithmetic in Congress and the challenges facing Joe Biden. Your views, particularly as they pertain to the infra market. We expected sort of that boom post Donald Trump's election, and hasn't quite eventuated. Just your thoughts on what Joe Biden's presidency means for infrastructure.
Yeah, well, obviously this is the second strand that he wants to do. He wants to get the pandemic relief bill done soon first, and then he's going to move to infrastructure. He's talked about $2 trillion worth of infrastructure. It's likely that he will tee up Congress when he makes the first address to Congress, first formal address, I should say, in mid-March. So I think that's when we're going to hear a bit more meat on the bone of what his plans are. The question, of course, though, is going to be, can he get it done? And the arithmetic is so tight. Now, he can use the budget resolution method a couple of times a year, a few times a year if he wants to, which means that he can get things through via the simple majority rather than the 2/3. But, you know, look at the way that Congress has behaved, is behaving now, has behaved in the Trump era. Very, very difficult, very polarized to try and get these things through. And he wants to do a bipartisan thing. He wants to try and heal the economy. I mean, it's going to be very, very difficult. I'm just thinking back to, for all his good intentions, I'm just thinking back to Donald Trump when he first came in. If you remember, you know, after the initial fanfare that he was going to enact a big infrastructure investment plan. And that was the thing that melted markets up, you know, late 2016, early 17. Most markets through 2017, you know, it was a slow death march. It was a grind. And actually, you know, by getting towards the middle end of 2017, markets were saying, you're a doozy. You can't get anything through. Nothing, the dollar was falling, stocks are dropping back. And then he managed, through the budget resolution method, to pass a $1 trillion tax cut, which was, despite his ambitions to raise long-term growth, just a sugar rush, because it was pro-cyclical. Yeah, you know, who'd have thought? And, you know, so it's very difficult. It can be done. We're just going to have to watch and see whether this guy, Joe Biden, has learnt from that. He knows the primaries are coming up in 2022. He knows he's really got to deliver. I think he understands. He can't repeat what Trump did and actually have a year where nothing is done.
I think, Gav, too,
I think there's a big driver here on the climate agenda with Biden, linked in with Europe, that's linked in even with China, and that's linked in with Boris Johnson, with the COP26 this year. They all want to push on the same, and they all want to be leaders on this. So I think there's a peer group pressure coming as well, which is the good thing.
Perfect, thanks, Gav. Just a housekeeping point, aware that we're hitting time, so we'll aim for a hard stop at 11:05, but we respect if anyone needs to leave before then. So next up, we've got a question from Helen at Blonde Money. I know you touched on inflation in your presentation, Gav. Will there be enough inflation to remove the deflation that's been in the system for the past 2 decades?
Well, that's the hope, isn't it, of central banks? I mean, you know, markets are, some areas of the markets are getting vexed by, you know, the idea that inflation is just going to rip. There's a good piece on Bloomberg the other day about Paul Volcker, deceased, and how we're just, we can't compare. Go back, rates at 15%, inflation at 15% back then. Now, the story of the last, decade or so has been inflation targeting central banks not hitting their inflation targets, and they all want to do it. The big story in Japan and Europe has been about disinflation and deflation, and how do we avoid it? Much more, damaging than a period of inflation, which central banks think they can nip in the bud. Well, that's a debate for further down the road, whether they can nip it in the bud, and it will depend on wages and those kinds of things. But certainly, as I said, the shift in policy from the Fed to average inflation targeting, they've not done that lightly. The markets see that as credible. They see it as credible in terms of getting US inflation to that level. And then there's going to be a debate after that, 2 or 3 years down the road, once we've gone through all the kind of supply chain disruptions and other bits and pieces and base effects, on whether it sticks, whether we really can get full employment, and then that pool of available workers dries up, and actually things start pushing up. We get good old-fashioned goods-driven inflation. And that's a debate for down the road. It's not for yet. Certainly, Jay Powell will be hoping that he is successful. And remember, the ECB is doing the same review. They've got a way to go yet, but it's possible they'll have exactly the same policy. There's more division there, as we've seen from people like Jens Wiegmann, on whether they'll go that way. But that's a story. Bank of England, again, they would rather rely on QE at the moment. They don't have the same inflation problem, I think, as the US, Australia, New Zealand, Europe, and Japan. It's not quite the same.
Gav, the next question, we've got 2 more and then we'll wrap it up. The next question is around, I guess, the reflation trade and people trying to get on that trade, but particularly around timing. So Boris Johnson sort of alluded to a slow release from the COVID measures that we currently have in place and the lockdown. Given all of that, is there a chance that the demand surge you talked about earlier is pushed back maybe 6 months towards the end of, say, Q4 and then early 2022? Or have you got a view on the timing of that?
Oh, I would think almost certainly. I mean, I think it's hard to escape this initial surge that's going to come. The thing that's going to change it is the virus itself. The mutations that we cannot foresee, things that come along, splice and dice it, that mean suddenly we're into more difficulties. We don't have that clear escape velocity path that we think we've got at the moment. Because as I said, drug companies are increasingly optimistic that they can tweak the vaccines to all of these things within 3 months, aided by the medical regulators. None of us can know what lies ahead with this. And so if you're right on that, then it will be because something's happened and we need to suddenly dose it up, tweak the vaccines further, and the whole thing gets pushed back. Entirely possible. I mean, it's a steep learning curve, and we continue to learn from this.
Yeah, agreed. It's part of what makes this such a challenging environment to invest in. Katie, maybe one last one from you, and then we'll let Fred and John wrap it up for everyone so everyone can get on with their day.
Sounds great. So last one from Deborah Ross. For the vaccine, if the advised dosage is 2 to 3 per person, why is the UK buying 5.5 doses per person? Do we expect them to donate excess doses to less developed countries? This may be where you're being required to be an epidemiologist again.
Well, it would be wonderful if they would do. There's been some discussion about this in the US. I think for those people that really know about this, and I'm not one of those, they think that the UK, the US, and even Europe will have much more vaccine than it needs, and therefore it ought to be being rolled out to the developing nations more quickly. I think, though, you listen to the government, and actually they want to make sure that they get the most vulnerable vaccinated, get that first dose done, before they move down that road. I'm not going to get into that because that's a question for them. But the question about why they've got so much is precisely because we will probably need a third jab. If this thing mutates further, you know, we're going to need more. It's not going to be just 2 jabs.
That's Gav. Yeah, that's a tough one to answer. I don't even think the epidemiologists know or the virologists know exactly what the plan is there, but it's a moving feast. So maybe we'll wrap it up there. There are some questions we haven't had a chance to get to, and we'll try over the next couple of days for Gavin and the team to get those back across to you, responses back on all of those questions. So if we haven't had a chance to answer your question, we will get to it over the next 24 hours. But maybe Fred and John, I'll pass back to you just to wrap up.
Sure. Thanks, Dave. Thanks, Katie, and thank you, Gav. Good sessions. So look, thanks everyone for joining us today. Without a doubt, and just as the last set of questions, the environment, the opportunities are going to be various, but obviously very, very challenging as the success of vaccination rollout and different strains, and this thing will keep playing, no doubt. But look, we hope you found the session insightful. We'd certainly welcome any feedback. Fred, again, thanks for your participation and cooperation. It's great to have a session with you, but I'm going to wish everyone a good day today, and I think Fred's going to close us out.
Yeah, thank you, John. Thank you, Gavin. I certainly found it very insightful. I'm actually looking forward to the next session because there is a lot of takeouts from this session, and I would like to ask a number of questions to Gavin in terms of impact on our clients and our real assets, as I mentioned. My big takeout is that you believe in the reflation trade, and that certainly is a positive outcome. So thank you very much for that. Thank you, John. Thank you, Gavin. Thank you, Dave. Thank you, Katie, for organizing this. And yeah, as I said, looking forward to the next one.
Thank you.
Thanks, folks.
Thanks,
Thank you all.